Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 May-June Paper 3-2 question number 3. This is the structured paper 3, which consists of 3 questions. Each of them will be of 25 marks, and the total time limit for this paper is 1 hour 30 minutes. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 3 under 30 minutes. So without any further delay, let's get started. Ray and Steve had been in partnership, sharing profits and losses equally. On 1st January 2023, they merged their business with Tina's sole trading business to form a new partnership. The statement of financial position at 31st December 2022 is given for Ray and Steve's partnership business as well as Tina's sole trading business. We have the non-current assets, current assets, capital accounts, and we have the current liabilities. We do not have any non-current liability in this case. The following arrangements were agreed for the new partnership. Profit and loss sharing ratio would be 40% for Ray, 40% for Steve, and 20% for Tina. Previously, Ray and Steve used to share profits equally. Then there would be no partner salaries and interest on capital. Goodwill was valued at 2 times the average profits for the last 3 years. The profits for the last 3 years were as follows. So we have the profit for the last 3 years for Ray and Steve's partnership as well as Tina's sole trading business. Let us first calculate the total of these 3 years profit for both the business. Then we can divide it by 3 in order to get the average profit. Then we need to multiply it by 2 in order to get the goodwill value. Let's do it for Ray and Steve's business. The total profit for the 3 years will be 97,000 plus 74,000 plus 78,000, which results in 249,000. And for Tina, that will be 19,000 plus 22,000 plus 28,000, which will be 69,000. Okay, let us calculate the goodwill now. For Ray and Steve, it will be 2 times the average profit, and the average profit will be the total divided by 3. So 249,000 divided by 3, which results in the value of 166,000. Then for Tina's business, it will be 2 times the total profit of 69,000 divided by 3. And this results in the goodwill value of 46,000. Another thing we know is that the previous profit sharing ratio for Ray and Steve's partnership was on an equal basis. So this goodwill will be divided among the 2 partners equally. So that will be 166,000 divided by 2, which results in 83,000 each for both Ray as well as Steve. And this will be the old goodwill. These 2 will be the old goodwill. Now the total new goodwill will be the sum of 166,000 and 46,000, which results in the value of 212,000. And this new goodwill will be divided among 3 partners, Ray, Steve, and Tina, based on their new profit sharing ratio. Okay. So the new profit sharing ratio is 40% for Ray. So Ray's share of goodwill will be 40% times 212,000, which results in the value of 84,800. The profit sharing ratio is the same for Steve, which means that the value will also be the same. And for Tina, it will be 20% of 212,000, which results in the value of 42,400. No goodwill account is to be kept in the books of the new business. This just means that we need to cancel out the old goodwill with the new goodwill value. Let's move towards the remaining information. All tangible assets and liabilities were valued at their book value except for the following. So we have revalued the land and buildings, inventory, and trade receivables for Ray and Steve's partnership as well as Tina's sole trader. In such cases, we need to know whether there was a profit on revaluation or a loss on revaluation. And in order to do so, we just compare the net book values to the revalued amount. In this case, for Ray and Steve's partnership, these are the revalued amounts. So we can just compare it to the net book values. Let's take a look above. For land and building, it's 230,000. For inventory, it's 38,000. And for trade receivables, it will be 75,000. So previously it was 230,000, 38,000 for inventory, and 75,000 for trade receivables. Now we can just calculate the total. The total of the net book value will be 230,000 plus 38,000 plus 75,000, which results in 343,000. And for the revalued amount, that will be 280,000 plus 35,000 plus 68,000, which results in 383,000. So we can clearly see that the value has increased after revaluation, which means that there was a profit on revaluation. And the profit will just be the difference of the revalued amount and the net book value. So 383,000 minus 343,000, which results in the profit on revaluation of 40,000. And this is the total profit, which will now be divided among Ray and Steve based on their old profit sharing ratio, which was to share the profits equally. So they both will get the amount of 20,000 each as part of their profit on revaluation. Then we need to repeat the same process for Tina's sole trading business. These are the revalued amount. We need to compare it to the net book value. Let's take a look above. For Tina, land and buildings was 109,000, inventory was 23,000, and trade receivables was 45,000. Let's write it down. So previously it was 109,000, 23,000, and 45,000. Let's calculate the total. For net book value, that will be 109,000 plus 23,000 plus 45,000. That will be 177,000. And for the revalued amount, that will be 130,000 plus 21,500 plus 43,000, which results in 194,500. For Tina's business as well, we can see that the revalued amount is higher than the net book value, which means that there was a profit on revaluation. And that will be the difference between the revalued amount of 194,500 and the net book value of 177,000. This results in the value of 17,500. Okay, let's take a look at our first question. We need to explain 3 benefits of a merger. The very first benefit of a merger is that it will reduce competition, which will increase the sales and profit of the business. So reduces competition, which might increase sales and profit. The second benefit of merger is that there will be pooling of experience as well as skill and resources, because the new owner will bring a new skill set as well as new experience and new resources. Let's write it down. Pooling of experience, skills, and resources as new owners may bring new experience, skill, and resources. Now, the third benefit of merger is that there will be economies of scale, because now the business can take advantage of bulk buying discount. Let's write it down. Economies of scale, as the business can take advantage of bulk buying discount. That is all for the first part. Let's move towards the second one. We now need to complete the following statement to calculate the capital account balance of each partner in the new partnership at 1st January 2023. In order to calculate the balance in the new partnership, we just need to adjust for goodwill and the profit or loss on revaluation. The first thing we can do is add the profit on revaluation. If it was a loss on revaluation, we would subtract it. So we've already calculated the amount. For Ray and Steve, that will be 20,000 each, and for Tina, that will be 17,500. Then we need to adjust for the goodwill. Goodwill adjustment is done by adding the old goodwill and subtracting the new goodwill. We've already calculated the values. Now we just need to write it down. Let's take a look above. For the old goodwill, Ray and Steve will have the value of 83,000 each, whereas Tina will have the value of 46,000. And for the new goodwill, Ray and Steve will have the values of 84,800 each, and Tina will have the value of 42,400. Let's write it down. So for the old goodwill, Ray and Steve had 83,000 each, and Tina had 46,000. And that will be added. Now we will subtract the new goodwill. For the new goodwill, Ray and Steve had the value of 84,800 each, and Tina had the value of 42,400. Those are all of our adjustments. Now we can calculate the balance at 1st January 2023 in the new partnership business. For Ray, that will be 198,000 plus 20,000 plus 83,000 minus 84,800, which results in 216,200. For Steve, that will be 177,000 plus 20,000 plus 83,000 minus 84,800, which results in 195,200. And for Tina, that will be 186,000 plus 17,500 plus 46,000 minus 42,400, which results in 207,100. That is all for the second part. And in this case, we have been given the workings box. So you need to show your workings for profit on revaluation, old goodwill and new goodwill clearly within this box so that you get your markings correctly. Let's move towards the third part. Now we need to prepare the statement of financial position of the new partnership at 1st January 2023. This is a new partnership after merger, which means that all of the non-current assets, current assets, as well as current liabilities values will now be combined. And if there is any sort of revaluation, we will include the revalued amount. If there is no revaluation, then we can include the net book value. Okay, so this is the statement of financial position. This is at the date of 1st January 2023. Let's start with the non-current assets. So in this case, one non-current asset was revalued, the land and building. So for land and building, we need to include the value of 280,000 plus 130,000 because we need to combine the revalued amounts now, and that will result in 410,000. And there was another non-current asset, plant and machinery, which was not revalued. So we can include it at the net book value of 68,000 plus 31,000, which results in the value of 99,000. Let's write it down. So we first have the land and buildings. We include it at the revalued amount of 410,000, and this is a combined value. Then we include the plant and machinery, and the value will be the combined net book value of 99,000. The total non-current asset will be 410,000 plus 99,000, which results in 509,000. Now we can include the current assets. For the current assets as well, inventory and trade receivables were revalued. So we include the combined value for the revalued amount. For inventory, that will be 35,000 plus 21,500, which results in 56,500. For trade receivables, that will be 68,000 plus 43,000, which results in 111,000. And there was another current asset, cash at bank, which was not revalued. So we can include it at the net book value of 19,000 plus 11,000, which results in 30,000. Let's write it down. We first have the inventory of 56,500. We then have the trade receivables of 111,000. We then have cash at bank, which is of 30,000. Now let's calculate the total. That will be 56,500 plus 111,000 plus 30,000, which results in 197,500. Then we can calculate the total asset. That will be 509,000 plus 197,500, which results in 706,500. Now we can move towards the capital section, where we will list down the capital of Ray, Steve, and Tina, and we need to include the values in their capital account for the new partnership, which we have already calculated in the second part. So that will be 216,200, 195,200, and 207,100. Let's write it down. So for Ray, it's 216,200. For Steve, it's 195,200. and for Tina it's 207,100. The total will be 216,200 plus 195,200 plus 207,100, which results in 618,500. We do not have any non-current liabilities, so we can move towards the current liability section. And there was only one current liability which was not revalued, so we need to include the combined net book value. That will be 55,000 plus 33,000, which results in the value of 88,000. So we have the trade payables of 88,000. Now we can calculate the total capital and liabilities. That will be 618,500 plus 88,000, which results in 706,500. In this case, we can see that the total asset value is equal to the total capital and liabilities, which means that our statement of financial position is correct. That is all for this part. Let's move towards the next one. Now, the profit of the new partnership for the year ended 31st December 2023 was 150,000. Now we need to discuss whether or not Tina has made the right decision to merge her business with Ray and Steve's business. We need to justify our answer. This is of 5 marks, so we need to have 2 advantages, 2 disadvantages, and a final decision. The very first thing we can do is calculate Tina's share of profit for the new partnership. So Tina's share of profit. Her new profit sharing ratio is 20%, so that will be 150,000 times 20%, which results in the value of 30,000. Now let's compare it to Tina's profit when she operated as a sole trader. So as a sole trader, we can see that she earned 28,000, 22,000 and 19,000 respectively in the years 2020, 2021 and 2022. These are clearly lower than what she is getting in the new partnership. Let's write it down. The share of profit post-merger exceeds the annual profit when she operated as a sole trader. Okay, these two will act as the advantages. Now for the disadvantages, she might have conflicts with other partners. So she might have conflicts with other partners. And we can also comment on her profit sharing ratio. We can see that Tina only has 20% as part of her share of profit, whereas Ray and Steve will be getting 40% each. So we can say that Tina has little control over the new partnership. So as per the profit sharing ratio, Tina has little control over the new partnership. Now we need to make a final decision. And in this case, I would say that Tina has made the right decision to merge her business, because if you take a look at her profit, we can see that it has a declining pattern. In 2020, she earned 28,000, then she earned 22, then she earned 19. So the profit was decreasing. Now post-merger, she will be getting a profit of 30,000, which is really good compared to what she was earning as a sole trader. Let's write it down. So the decision is that Tina has made the right decision to merge her business as her sole trading business's profit is on a declining trend. Alright, that is all for this question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.